Hello, everybody. About ready to get going? Where's Hank? Hank, where are you? Yeah? Okay. All right. Hey, welcome everybody to Cleantech Investing, Emerging Trends and New Strategies. This is a panel presentation this evening, and it's part of a series for the Energy and Cleantech events series for the MIT Club in Northern California. Just a couple really brief introductions. We have the president of the MIT Club, right over here, Bill Rienstra. Just want to say thanks for coming this evening. And then also the head of the Cleantech series for the MIT Club, Doug Sprang, who's in the front row. All right. So the Cleantech series is an event series that's run by the club, and it goes on from approximately September to May. About one event a month, and it runs a gamut from panels like we have this evening to notable professors affiliated with the MIT Energy Initiative back at Cambridge, as well as tours of interesting facilities, such as, I guess the new one, the ones are the tour of the Calpine natural gas power plants coming up, as well as other types of events like that. So anyway, tonight we have a panel, Cleantech Investing, and we certainly hope you enjoy the presentation. And with that, I'd like to introduce our moderator, Eric.
All right. Thank you. My name's Eric Westhoff. I'm the editor-in-chief of Greentech Media. Hello. We've done this before, many of us. I fondly remember, I look back fondly on my imaginary years at MIT and my imaginary degree from MIT. And so thank you. It's like a reunion. So over the last 10 years, billions of dollars have been invested. I'm a reporter, I should know. Billions of dollars have been invested in clean tech. Billions of dollars have been lost. Hundreds of companies have been formed, and hundreds of companies have failed. And a lot of venture capitalists who were in the clean tech venture capital business are no longer in the clean tech venture capital business. These gentlemen are still in the venture capital business. They come from a variety of different asset classes, and you'll hear from them. It's an honor to have most of them here with us. So Greentech Media covers renewable energy and alternative energy, and we do a great job. I hope, if you read, I hope you agree, because right now things are just thicker and the business is just moving faster than we've ever seen it before. And it's actually good news for a change. If you bought solar stocks at the beginning of this year, they've tripled. For solar, SunPower, American companies have tripled. There's a little bit of acquisition going on in solar. You can't drive around these zip codes without running into a damn Tesla. And so there's been a lot of mistakes in VC, cellulosic ethanol, certain types of thin film solar, and a long, long list. But I wanted to talk a little bit about some of the good news, which is the companies that have gone public in the last couple of years, or the public companies in clean tech who are succeeding. So SunPower, First Solar, newly public Enphase, a small microinverter company, Silver Springs Networks, a smart grid pioneer, Solar City, Nest, anyway, O-Power. There's a really long list of VC-funded companies that are succeeding and doing extremely well, and they're dislodging a 150-year-old incumbency. It's not like a Facebook or a YouTube where there's no incumbent. We are dealing against utilities with highly regulated utilities who do things at their own pace, and these investors are trying to change that pace a little bit. So uncharacteristically, I'm going to be quiet and move right to the investors. The first investor the first person to talk is going to be Pierre Lamond. If you have been in the lobby of a company in Silicon Valley, you've come across the genealogy chart. Do you know what I'm talking about, the genealogy of Silicon Valley companies? Well, Pierre was at the root of many of those, or at the root of that poster when he was at National Semiconductor and Fairchild. In '62, he worked with Gordon Moore. So he is a Silicon Valley pioneer, and he's lived through a lot, and I hope we can hear a little bit about what he's lived through when he comes to talk. All right? Pierre, you're on. I think. There. I'm a Mac.
No, you skipped 2 slides.
Okay, main tech.
Okay, I used that slide last year when I was invited, and thank you very much for inviting me again. I feel like I'm becoming a real star in a diminishing number of people investing in clean tech. But this is an idea that Vinod Khosla came up with. I explained that last year, but basically clean tech encompasses so many different technologies that it's really main tech. Let's go to the next slide. So I got this information out of the National Venture Capital Association, and this represents for Q3 of every year the amount that was invested. And I don't need to tell you what to focus on, you'll see it by yourself. 2013 has not been a very good year, and Q3 is representative. If you look at from 2006 onward, the average per quarter, investment per quarter in venture capital into clean tech, approximately $1 billion. It's less than 250 in Q3 of 2013. What is more concerning in many respects is that we see very few, if any, startups. There are very few people going into, and for good reasons, frankly, because they can't find the money. Even if you have a good idea, you find very few venture capitalists that are willing to put money into anything that's clean tech. And if it's solar, then it's really bad. So the next slide, please. This is what we've been pushing for a while at Khosla Ventures, that really clean tech is many different things. And it's not just component, the technology is infrastructure redesign. And if you bear with me, I'll give you the names of some of the companies we have invested into these areas. A company called Verentech, which is basically makes a device or a system that improves the grid robustness. It has another advantage is that if you install the device and there's a portion of the grid that goes down, the operator will find out very quickly. And so there is a cost advantage, so they can send a truck to repair the problems they have. Then there are, companies like Bloom. Bloom is represented here. I don't have an investment in Bloom, but Vinod does. But we have another company called Etogen, which is, in some respect, also in the field of distributed generation. In more efficient generation, there is the whole issue, and that, by the way, is an area where there's still investments to be made, at least in our view. It's grid-based storage and efficiency. So you have companies like Lightsail, making a storage system based on compressed air. Very interesting technology. They soon will have a prototype. But you have some other companies like CO, which is a lithium-ion battery that has one major advantage: it's very safe, doesn't burn, doesn't explode. But the unfortunate things here, and I will talk more about this later, CO is a very successful company at the prototype level. Can't find investors in the United States. So our investor is going to be a strategic in Japan, in China. And many of the companies I'm going to talk about here today are going to China, which bothers me in more than one way. But other companies for efficiency, there's Sora that makes a very efficient LED, Avogy, which is a company making gallium nitride, very high voltage transistors, applications for the grid. I'm talking about 1200 volt, 1600 volt, and soon 3200 volt transistors. Crop rotation, we have investments in a company called Blue River. And Blue River is basically a robot that helps the people that have lettuce fields. I won't go into the detail, but it's actually a very amazing technology. Solum provides data, big data for people for farmers that are worried about the amount of fertilizer they use. We made an excursion into replacements of meat and cheese and eggs. I don't know if that really fits into clean tech, but basically the idea is to replace meat. I mean, beef is a very bad animal from an environment point of view. Grazing, takes 2/3 of the land in the world, and it's not a good use of that land. So we invested in a company called Solum that gives the farmers statistics on on their crop health. Then we also, we made this investment some time ago, looking at carbon capture and reuse. The most interesting company we have in there is a company called LanzaTech, which takes the gases coming out of steel mills and turns them into a useful chemical like ethanol or other, excuse me, more complex chemicals. Here again, by the way, they have a pilot plant in China and are building, that works, by the way, and building a big plant in China also. Now, there is a reason for that, is that most of the steel industry has immigrated to either China or India, but it's a shame that we don't see any applications in this country. In terms of material science, we invested in a company called View that makes electrochromic glass, reduces the amount of heat loss or sun that comes into a house or a building. Calera is a company that does carbon capture and makes cement with it. And then we also have a very investment in a very early stage startup called Arcanum, which has a new way of making stainless steel. And finally, biofuels. Biofuels is a terrible place to be in these days. For a very simple reason, this country is swimming in oil and has more gas than we can use, and so why use biofuels unless it's a religious issue and you want to be green? So Cure, which is a very successful company from a technical point of view, has a pilot plant in Mississippi, is trying to raise money to really build.
Pierre, it's not my pay raise. It's not my pay grade to interrupt you. Okay.
I mean, I'm finished.
But Khosla has 650 clean tech investments, so we can't go through them all.
I'm finished.
Okay. Would you? I don't think my normal methods are not going to work tonight. Would you consider Khosla, I don't want to categorize it, but is it a strictly early stage? I know you have an impact fund, but is there also late stage investment going on? By
and large, we invest in early stage only.
Okay. All right. I apologize for anything I've said. Can you want to continue with this?
I'm through.
I wasn't keeping up with that. I'm sorry.
I was through, actually.
Okay.
Go ahead.
Next.
How long did that take?
Scott, we're going out of order. So, Scott, you're next.
I'm Scott Jacobs from EFW Partners. Thanks for having me. I think I was at a MIT event actually 5 years ago where the question was, is clean tech main tech? So very appropriate that Pierre led off with that statement. EFW Partners stands for Energy, Food, and Water. We're about a year old. We invest thematically in energy, food, and water. If you think about investing, it's really about risk management. And we believe that the current way that investors think about risk is broken. And if you think about some of the large-scale thematic risks that we have in the world today, whether it's climate change or resource scarcity or environmental externalities, we are very ill prepared to address those risks from a strategic asset allocation standpoint. And so my work at McKinsey prior to starting EFW was partly to advise sovereign wealth funds, pension funds, and long-term investors to think differently about risk and to think differently about themes like these: water scarcity, climate change, and commodity-linked inflation in emerging markets. And it became clear that the investment world was just not well structured to address those. And a few family offices gave me the opportunity to start with a few partners a new thematic investment firm that doesn't sort of conform to traditional notions of venture capital, private equity, fixed income, project finance, et cetera. So we invest across categories, across asset classes, across sectors. We have three main areas that we invest in: innovation, which is all about the economic engine for growth for the last 150 years. We believe the agricultural revolution, the industrial revolution, the digital revolution were all about the productivity of the laborer, and we're basically done with that. That is now the reason we need to turn our attention to the more expensive and more difficult inputs to the economy, like energy, food, and water, and other basic resources. So our innovation strategy invests in anything from early stage companies through to public companies, both equity and debt. And we have a portfolio of about 7 investments now in that innovation category. If you want to reinvent the world, one of the mistakes Silicon Valley has done in this space in the last 10 years is thinking that you can just reinvent the world without rebuilding the world. And so that tees up our second strategy, which is infrastructure and real assets. You actually have to rebuild the world with some of this new innovation, or the innovation means absolutely nothing. And so we invest in cash-yielding assets from development stage all the way through operating assets. And we think there are a lot of great mispriced opportunities because, again, risk is mispriced and misunderstood in this space. And then thirdly, we invest in what we call special situations, which is really anything else. We have the good fortune of being flexible, and we can be therefore opportunistic. Our research, again, is thematic and not specific to an asset class or sector, so we can both see deals and do deals that a lot of others who are constrained to a single mandate would have trouble doing. So that's who we are. We're knock on wood, it's early days. The fund is performing very well. We have a long way to go. We're just 3 partners and a few other folks. But we believe that you need to fundamentally reinvent risk and risk management, and that's what we're trying to prove. And so far, so good. So thanks.
Good. I'm noticing some energy storage companies getting funded and customer traction, not so much for the rate arbitrage that they're doing, but the sheer backup power that they're providing in light of superstorms. And so energy storage is much more important for backup power in critical systems than other more Byzantine schemes that people are working out for rate gaming that people are talking about energy storage. Does that make a little bit of sense? Is that kind of what there's a risk created by climate change and there's a business to be had there?
Yeah, I mean, it's anything from innovative technologies being used, obviously, to mitigate risk to investments in alternative materials that are not necessarily new, but are now a better price than something that has become scarce and difficult to access. It's anything from some of the food companies that Coastal Ventures has invested in, where chicken eggs are a ridiculously intensive production process, and there are novel technologies and processes that could allow us to replace mayonnaise with plant-based egg-like substitutes. So it runs the gamut. We basically say if you understand that resource scarcity is a big problem, you either buy the resources themselves because they're going to go long-term up and to the right. You buy the replacements to those resources because at some price you're going to have to replace them with something else that's cheaper, or you buy the productivity solutions, right? The things that allow you to do more with less, the fundamental economic engine of sort of all time. So it's a pretty straightforward, logical conclusion that you would take.
But you did say that some of the mechanisms for investing in Silicon Valley are broken, right? You heard the first question I asked, I'm a categorization. Are you in early stage or late stage? That's trying to think of it like that is a mistake, is kind of what you're saying, yes?
That is definitely our view, yes.
Okay, all right. Stuart, would you give us your 5 minutes?
Sure. You teed that up, I thought, because I'm a late-stage venture investor. So, Scott, just said our strategy doesn't make sense, but I'll explain that. Just one or two slides on what Goldman Sachs does, one or two slides on kind of how we think about the environment at a macro level, and then a couple of slides that might just be interesting as we think about the sector as a whole for the later discussion. So what do we do? I run a group that does three things. We advise, finance, and invest in clean tech companies. It's pretty unusual for an investment bank in banking to do the third. Advice and finance is obvious. We help companies in M&A. We take them public. We do other financings for them. But we also invest in our group off our own balance sheet. And it's late stage financing, and I'll come back and talk about why. In 2005, we indicated that we were very focused on the environment at Goldman Sachs, and we're interested in being dedicated to the space. And we made a commitment in 2005 to invest or finance $1 billion over the next 10 years. And back then, people said, $1 billion, that's crazy. Who's going to put $1 billion into this space? And you can see we did it very quickly. In fact, by the time we got to 2010, we had investor financed 20 plus times that level. And so we decided we needed to make a renewed commitment, and so we made a commitment to investor finance $40 billion over the next 10 years, starting in 2010. That's invest and finance, so it's not all of it off our balance sheet, but some of it is acting as agent on behalf of our clients. And there are other things we're doing. For example, we've made it a commitment to be carbon neutral by 2020. We're very involved with not-for-profit organizations, including NRDC, thinking about energy efficiency and water use in New York City and Philadelphia, respectively. So it's something that up at the executive level at Goldman Sachs, we're very focused on. When we think about what we do in terms of an ecosystem, in our summit, which I'll talk about in a second, is called the Clean Energy Ecosystem Summit. And it's not just about companies and it's not just about investors, but it's a much broader group than that. And it includes universities and labs, it includes government agencies, it includes environmental organizations, and all of those are a really important part of the solution here. And just for an example, when we had we used to have this conference in New York when there were 700 people, and it was mostly investors and companies. And we said, we're going to skinny that down. We're going to invite just 200 people, the most relevant people, but it's going to be from a broader group of people, this broader group of constituents. And so you can see on that, the government agencies, we invited the various companies, many of which were coastal venture companies, actually. They've got a terrific portfolio. Utilities, regulators. It was really a very thoughtful and provocative discussion. The one, as it strikes me as I look at this, one university we need to have represented this coming year will be MIT. MIT, Stanford, Berkeley tend to be the three most prominent organizations, or institutions and universities focused in this area and really doing terrific work. Because I've spent 17 of my years at Goldman in capital markets, and because one of the things I do is take companies public, everyone asks where are we in the business cycle generally, and so I'd like to talk about business cycles as sine waves, and this is just one sine wave. In my career, I've probably been through seven. I started in '86, 7 business cycles, but the most recent one, which was probably the most traumatic. Nothing could go wrong. In 2007, people were investing in a lot of things. And of course, as soon as everybody thinks that way, that's exactly when the world starts to fall apart. And you can see the Lehman Brothers collapse, the market troughing in March of 2009. And it's exactly when everyone thinks the world's going to continue to fall apart that you want to start investing again, but very few people do. In fact, it was 2 years before investors actually started going back, 3 years, and still retail investors started getting back into mutual funds. The fund flows were negative for the next 2 years, even though the returns were extraordinary. And the clean tech cycle is similar, but has an even greater amplitude. So here's the cleantech sine wave, and you probably can't read it all, but the ups are greater and the downs are greater. But through that, companies have managed to go public. And so Cure was one that Pierre mentioned that went public in June of 2011, but Silver Spring Networks is another one you mentioned. Solar City, just to give you one example, when we took Solar City public this time last year, it was almost impossible to get anybody interested in that company. We sold it at $8 a share. We couldn't have gotten it done at $8.01. It was $8 or no deal. And there were very few investors that were focused. We were really believers in distributed generation. And here we are now, and the company's up by a factor of 5. It's not only the best performing cleantech IPO of 2013, it's the best performing IPO of 2013. And that's a very interesting space. And so the takeaway from this slide is, whatever you think things are looking horrible, that probably the cycle is going to change. And you've got to be long-term and very focused on this. And we are at Goldman Sachs, at least. We decided when we got in this business, we would take a 20-year view. Just to give you a couple of data points, and you referenced them earlier. So here's 2012, or when solar space was down. In fact, if you look at certain solar space stocks, they were down even more meaningfully. 2011 was a bad year too. Advance 1 year, 2013, solar stocks up. You said 3x. This might be looking at an index. You can look at certain specific stocks that are up more than the index. The NASDAQ Clean Edge Index outperforming the S&P 500. So just here we are 12 months later, the whole world looks different. The other thing we talked about at our summit was something called the tipping point. And again, it may be hard to read the slide, but I'm sure all of you have seen this. Every new innovation people thought was ridiculous at the time it was invented. Telephony, automobile, air conditioning, color TV, even the people that were closest to that space thought that the market was going to be rather modest. And it was 4, 5, or 10 years, and then the growth curve was remarkable. And so just step back for a minute. When the Prius first came out, very few people bought that car. Now, if you drive around this area, everyone has one. In fact, I was, living in Greenwich, Connecticut at the time, I was the first person to buy that car. People would stop me and say, "Look, don't you understand? In Greenwich, we buy Mercedes, BMWs, and Range Rovers. A Prius is just not an acceptable car in this neighborhood." And fast forward 5 years, everyone had a Prius. I put my name in for the Model S in 2009. I think I was 246 on the list, and everyone thought I was crazy, unproven car. You drive around this area, everyone has one. Pierre mentioned Sora, which makes LED bulbs. Very few people have them in their home right now. We just built a house, and every bulb in our house is an LED bulb, and most of them are Sora bulbs. They're beautiful. They've got a terrific it's a wonderful company. And I'm not just trying to push Pierre's portfolio companies. Wonderful CRI index. That's at a tipping point. A few years ago, they were $60 a bulb. Now you can get them $6 a bulb. Pretty soon they're going to be less than that. Who's going to buy an incandescent bulb or a fluorescent bulb when you can buy an LED
bulb that will outlast your marriage?
No.
Hopefully not.
It's true. It's true. Not yours, but the average national marriage. So I wanted to say on this chart, just 2/3 of the solar in the United States has been installed in the last 2.5 years. And so the tipping point that you're talking about is happening now with solar. In fact, this year, in 2013, there'll be more solar installed in the United States than in Germany for the first time in 12 years. It's the first time that the U.S. has eclipsed Germany in solar installation.
And part of it is because it wasn't that economical before. It used to be $100 a watt, now we're 50 cents a watt. And so as you drive down the cost curve, these things, the adoption rate goes up dramatically. I think I've got one last slide and a couple of backups we can refer to. Oh, this Pierre talked about a bit, but of course, when valuations were highest were when most venture capitalists put their money into the space, and then it was 2007 and then 2013 when valuations have come down. There's less money going in the space. But I think that's good for the people that are remaining, because if you're contrarian, you want to invest when everyone else is leaving. The last slide I'll make is, and this is incredibly important, you talked about the mistakes people have made. At the end of the day, many of the sectors, and there are many subsectors in clean tech, but many are in commodity business. And if you're in a commodity business, you've got to be a low-cost provider, and you've got to be very aware of the other competing sources of energy. And so I won't spend a lot of time on this slide, but it's interesting to see, in 2008, when oil was 150, competing sources of oil looked very appealing. As oil fell dramatically, competing sources of oil were less appealing. Ethanol, for example. Natural gas, $12, $14 wasn't that interesting. There were a lot of competing technologies that were appropriate as it went down to $2, $3. Then you've got to be very, very competitive to compete with natural gas. The same is true for every other commodity. So I think I'll stop here. We've got other slides we can refer to, but keep in the back of your head, commodity prices are critical.
So the cyclical nature you've mentioned, the sine waves you keep talking about, Pierre showed a slide that showed that painful Q3 drop-off in VC. Do you see a cyclical nature of venture capital investing? I know this is actually one of the questions that was given to me earlier, but it's appropriate to ask it now. Is that cliff that U.S. VC has fallen off of, as measured by PricewaterhouseCoopers or whatever that is that going to? Are we going to hit 2008 levels again of $8 billion put into clean tech? Is that ever going to happen again from the venture capital asset class? I'm sorry to be category.
You're best able to respond to that.
Well, first of all, ever is a long time. So I don't know. But right now, there are no sign of revival. I mean, I have, as you can see, we have quite a few companies in our portfolio, and you don't find any venture capitalists except, there are a few exceptions, but if you say clean tech, they're not interested. The issue is that in spite of the fact that there have been a few winners, there have been a lot of well-publicized losers. And people say it's much easier to make money by investing in the cloud, software as a service, let alone the next Facebook or whatever, Twitter. And so we find it very, very difficult to get companies to get Series B. They have a product, they're ready to expand the production, can't get Series B.
I couldn't have found a better segue to go to our corporate investor. And so Joel is with Google.org. Again, I don't want to put you into a bucket, but Google is a corporate investor, for lack of a better word, and maybe they're one of the solutions to that round B vacuum.
Yep.
Oh, what am I supposed to do with this? Slideshow. Slide master, no. Where? Thank you. Sorry. From beginning. Can you just go with this little itty bitty thing? Come on. Someone who's come on. Thank you.
When you're done with this one, can you bring up the second slide in the overhead series?
Okay.
Next slide, please.
Help me with that.
So I'm here to talk about energy investing at Google, which is where I spend most of my time, but just wanted to put first the context for that. Google's a company that cares a lot about sustainability. We're a company that's carbon neutral by virtue of a number of these activities up here. We do a lot in energy efficiency. We do a lot in renewable energy, and we make up the rest with offsets. In addition to that, we try to build some green attributes into our products so that people can live greener lives. Moving on to the next slide, just a bit on what we're doing in renewables aside from investing. We're doing what we can on our campus. We've got 1.7 megawatts of solar, landfill gas cogen, solar hot water heating, and we're constantly looking at things to make economic sense to help our campus be greener. In addition to that, we've made, in my opinion, a rather large commitment to procuring green energy for our operations, particularly 570 megawatts of wind power that we've procured to help green the energy supply for our data centers. So that's some of the other stuff that we're doing. If we go to the next slide and talk about what we're doing in renewable energy projects. we're investing in large-scale energy projects that are, driven by solar, driven by wind. We look at geothermal. We look at HVDC, high voltage transmission, DC transmission, and despite the fact that my title says Google.org, we're really focused on making a financial return. Google sees this as a business. We see that we can make good risk-adjusted returns in deploying renewable energy technology into the world. So we've invested over $1 billion. The projects total up over 2 gigawatts of renewable energy capacity.
That's the Ivanpah CSP plant.
Yeah, on the bottom left, that's the Eye of Sauron, according to many people. It's 175,000 mirrors that focus heat on a steam boiler. And on the bottom right is a wind farm, which I honestly can't tell you which one it is, maybe in Southern California.
In terms of BrightSource, you're an investor in the project itself and not the company, right?
We're actually an investor in both. There's been a couple of eras of investment in energy at Google. In sort of the mid-2000s, we made a couple of VC investments, including one in BrightSource. We don't own much of that company anymore, but the large investment was $168 million we made into the project that they built in Ivanpah. It's a roughly $2.2 billion project.
I think you invested in an enhanced geothermal company as well?
Yep. Potter Drilling, Alta Rock,
yep.
Makani Wind is another one. There's a few others.
Makani Wind?
Makani Wind,
it's the...
high altitude kites to generate
That's
wind
what happens
power.
when you give lots of money to windsurfers.
That's how it started. So, a lot of what we've done when you look at the dollars that we've invested have been proven technologies, and we're really deploying that technology onto the grid. And I think part of that was a reaction to making those early stage VC investments. We want to see a more immediate impact. Perhaps more relevant for this discussion, we also invest in technologies that are earlier stage, projects that have some track record, but not necessarily enough for the sort of run-of-the-mill banks and other typical investors to invest in. So those sort of transformative technologies that we invest in, as we call it, are ones that we see a lot of potential in, and that need that boost from first commercial project to really a well-proven, established, bankable project, so they can come down the cost curve, helping to accelerate the growth of renewable energy, or to integrate renewable energy, or deliver renewable energy from where it's created to where it is needed. A couple of examples of that are as you mentioned, the BrightSource Ivanpah project. It's almost a 400 megawatt project. The previous largest was, I think, 10 or 20 megawatts in Europe, so a large scale-up risk there. The Atlantic Wind Connection is an HVDC line off the coast of the New Jersey down to Virginia, which is intended to bring 7 gigawatts of wind, 7 gigawatts of offshore wind into markets where it's hard to find scalable renewables. You can get little chunks of solar, a little bit of wind in most markets, but not large chunks like that. And then we also supported with funds, Clean Power Finance and Solar City, to build portfolios of rooftop, and that's become a relatively mainstream market now. But a couple of years ago, it was. It felt pretty interesting, and we did our work and thought that it was a good risk to take in a market that we wanted to support, while in addition making good returns. So that's it for now. Happy to.
All right, I've survived the audio visual part of the program. No, I haven't. I have to put this slide up. No.
Just go with one more slide.
Okay. Help me here. I can do it. I am a Mac user. Forget it. I'm done with you. About 12, 15 years ago, I was part of a startup, a founding team for a telecom startup building optical switches during the great MEMS optical switch scare of 1999. And one of the investors we went to was Mr. Lamond's previous employer, and we pitched our company to Pierre. And he was extremely kind and polite, and he gave us some good advice, and he said, "Have a nice day." We eventually found far less polite but stupider VCs to actually invest the $6 million in what became a failed company. Good call. But so my question. I've actually, and I founded a company that survived as well. But so what are you looking for, Pierre, when an entrepreneur walks into your office? And is it the, again, this is the standard early stage venture capital question, but what do you want to see? What are you checking off in your mind when you see a CEO or a CTO and a team and the germ of an idea? What for the entrepreneurs in the audience, what do you want to see? What do you want to see out of that team?
Well, we always look at the market opportunity. If there is an existing market, we'd like to have a company that is entering a market that's growing very fast and has an unfair advantage over existing competition. In clean tech, you really don't have you don't want today to invest in existing technology or just having a minor advantage over the competition. So you really need to find companies that offer something totally new, where it's very difficult to assess what the market potential 10 years from now, for instance. And so it's much more risky from that point of view. But one of the things we look at in clean tech these days is companies that will not need a lot of capital equipment to build a factory. If you ask me today what I would look like, what company I would like to see in terms of investment in clean tech, and by the way, I haven't made any clean tech investment in 2013, and I will not, most probably. But a company that's involved in software rather than hardware. A big data company, for instance, that works on statistics about the grid or whatever, improving the efficiency of the distribution system, or the homes. But if the company needs to build a factory that will cost $50 or $100 million, I would not make the investment today.
But Pierre, you have, Coastal Ventures has, you mentioned LanzaTech. They're building a factory, or they're using Chinese checkbook to build it, right? So why it wouldn't make sense to discount that company if you can get that check from China. And I think there's another Coastal company, is it Eco Motors, that is also involved in a Chinese
right. You're correct.
Joint venture. So there are other sources for...
Oh, they are, by the way, there are corporate partners also in this country. I mean, we don't have to go only to China. And I prefer not to go to China, having been in Beijing a few days, not too long ago. But no.
Hence the coffee.
The Chinese... I've got to be very careful here because I will hear a joke about the French very soon. It's true. I mean, we have, LanzaTech has a relationship with Baosteel. Eco Motors has got a relationship with a Chinese manufacturer of engines. And I have a couple of companies that are now in the later stages of doing deals with Chinese companies. But, first of all, it's very difficult to do. Secondly, I need to get that famous Series B or Series C from some other US-based investors to get the company to be viable as a joint venture partner. So that's very, very difficult, I find. But there are some strategic partners in the United States, or for that matter in Europe. But it's not, it's not the classical venture capital type of thing where you did a seed, a Series A, a Series B. You found later stage investors that wanted to invest when the company was close to production or already had started. It has changed, the landscape has changed considerably for clean tech. Working with strategic partners also has some downside. I don't have to tell you that when you deal with China, you have to be very, very careful. I tell my companies that they should get their internal internet, Ethernet connections separate from the outside internet. We have an air gap. Mm-hmm. Not only that, but we make sure that a building is not connected in any way One way to get into a system, by the way, is that building management systems today very often have a connection to the internet. That's the easy way to get into your system. And I can tell you that they broke into Kostler Ventures system and got into Vinod Kostler private email. So you're going to be careful these days. And when you deal with the Chinese, you're going to be particularly careful.
All right. So Stuart and Scott, is the standard orthodox venture capital model, I'll ask it again, is Sand Hill Road broken for clean tech? Is the only way to go is these stage agnostic, 20-year long-term visionary horizons rather than the limited VC horizon?
I think it's too much of a generalization to say it's broken, in part because I think, as Pierre referenced, there's so many different subsectors. It's not just solar and wind and water, but it's efficiency and storage, electric vehicles,
food.
lighting, food. And so it really is subsector dependent, the answer to that question. The one mistake I think most venture capitalists would say they made in this sector, if you're speaking generally, is that they underestimated the capital requirements of some of the companies. And even if you're a large venture firm, you can't put an inordinate amount of money in one company. So you've got to find a syndicate to invest with you, and then later you need to find strategic investors and other parties. And if you're going to build a plant that's $500 million in size, that's a very meaningful investment for almost anybody on Sand Hill Road.
Did that come as a surprise to any of the venture capital investors, that if they were going to compete with coal generation and natural gas generation, they were going to have to build 100 megawatt factories and 200 megawatt generators? So why did that come as a shock?
Well, I think there were a series of surprises. One is things generally take longer than you expect to build.
Cost hell of a lot more.
There are technical setbacks that you don't expect. I pointed to the graph of commodity prices. That was a pretty dramatic turnaround, and that meaningfully impacts the economics of what you're doing. And if the economics of what you're doing are impacted, your ability to attract other forms of capital are impacted. So some of these things maybe you could have anticipated, others it was more difficult. I think it's premature to whip the industry. If you think back, you mentioned 1999. I was running our tech capital markets business from mid-90s through 2002. People were investing in a lot of technology companies in the late 90s that weren't around in 2002 and 2003. We remember the ones that are still prevalent. So in that period, Yahoo went public and eBay went public and others like that. You remember very few, and then there are hundreds that don't exist any longer. So we're in a volatile industry, and it's the early stages of that industry. People made mistakes, but that doesn't mean that investing in it is a mistake.
Yeah, I would just add a couple points. I think that the thing that surprised most of the Sand Hill Road community, from my point of view, was not the well-discussed valley of death that was about the scaling of these technologies or the deployment of these technologies. What was misunderstood by most early-stage investors was how long it took to prove the technology, and how long it took, and how much capital it took to prove a technology, which is very different from IT and even life sciences, but more similar to life sciences than IT, certainly, where you have to go through a bunch of regulatory hurdles before you can prove the efficacy of a new innovation. And I think that's still not well described in the media and whatnot, that it takes a long time to prove a new energy technology, to prove a new food technology, water technology, because of the other members of the ecosystem and their positions of conservatism. Whereas in digital technologies, there aren't those players involved that need to validate it. The second point I'd make is we continue to make the mistake of calling this a sector. This is not a sector. Like Stuart said, this is a lot of subsectors, but it's not a sector. There's no such thing as clean tech. This is industrial technology or main technology, whatever you want to call it. But it's not a sector. It's a theme about doing more with less of scarce and precious resources. And so what we tried at McKinsey to educate people was that this was not the third leg of the VC stool with IT and life sciences. This is like everything out there. Literally everything out there has something to do with what we call clean tech. And it's therefore no surprise, if you think about it being industrial technology primarily, that it's not going to be based here in the US. China and Germany are the centers of industry and industrial manufacturing and production equipment. Japan, Korea, not the US anymore. And so while I agree with Pierre that we can lament the lack of leadership that we have here in the US because we've been typically leaders when it comes to innovation and things like digital, we aren't the leaders anymore when it comes to main tech as a country. Main tech leadership is in Korea and Japan and Germany and China and other places. So that's not a surprise, and I think that is something still misunderstood by the Valley.
So, I'll bring up a Coastal Ventures solar investment. It's Steinman, and although every solar company's thin film solar company is having their bumpy road, they're building a factory in Hattiesburg, Mississippi, somewhere in Mississippi. Brad Mattson, who's a friend of this audience, wants to build a solar company at 300 megawatt scale in the United States, saying that thin film requires such a small footprint that you can build these things in the United States and you can scale. So there are investors who would counter there are technologies that can be built in the United States.
May I add something to what you said? I think one of the problems with venture capital in main tech, what we call main tech, is that there was a tremendous amount of over-investing. You know, if you look at solar, everybody knows. There was also an issue, in my mind anyway, with misplaced government subsidies that distorted the market. But you know, you look at batteries, for instance. I don't know how many battery companies have been funded in the United States. I don't have the statistics, but I would say 400. I mean, how many battery companies can be successful in the United States? I don't know, but not 400. On the other point you made about the move of industrial production from the United States out of the United States to China and other places, it's a little bit too political in my view to talk about here. But the fact is that we have a major problem in this country in not having trained people to do things that they used to do 20 years ago. You can't, in Silicon Valley, it's very difficult to find a really good vacuum technician. I mean, you want somebody to maintain vacuum equipment, you can't find anybody. Because there's this idea that everybody should go to a 4-year college. Well, I don't agree with that. In Germany, they have this very strict program of apprenticeships. And you go out of high school. Engineers, by the way, go through 2 years of apprenticeship before they go into engineering school. In this country, we say everybody has to go to college. Well, it's not true. Some people could make very good money and could be very good technicians. And we have lost this sort of intermediate stage. It's a real problem. Because I would like, personally, I have a company that is based in Hayward. And I would like to have a factory not far from Hayward. Instead of that, the factory is going to be in China. Well, it's not easy to transfer a process from here to China, believe me. It's not easy. And I've transferred a lot of manufacturing. When I was at Fairchild, we opened the first assembly plant in Hong Kong. So I remember that. But it's tough. And it's bad for this country in some respects.
Very bad.
All right, let me shift gears a little bit just to give Joel a little time. Joel, what is the thesis of Google? Or let's go back a little bit. Are you investing solely for Google-related applications? Are you done with investing in Makani Wind and sort of interesting early-stage startups? And are you really focused on that late-stage PPA already signed on a wind farm or a solar farm?
Yeah, so a lot of what we're doing is on the lower risk deployment end of things, for sure. Like, PPAs on the solar farms, wind farms, we're, of that over $1 billion we've done, and the great majority of that is there. You mentioned Makani. We actually have Makani in-house now, so we're still continuing to incubate and support that company. But I'd say we're not the only investor within Google either. There's Google Ventures. They're doing some clean tech investing. That's not really a focus area for them per se, but they're in Cool Planet. They're in Clean Power Finance as well from a corporate side. So within Google, there is still risk tolerance, and I think you see that broadly writ, and the fact that we're going after robotics, we're going after Google Glass, we're going after high altitude internet. So there's a lot of risk tolerance at Google that still remains to be the case.
High altitude internet, it's like drone based. Drone-based
high altitude balloons that float with the air currents, and you drop down a little bit, you go a different direction, you raise up, you go a different direction, so you can keep your balloons kind of covering.
So for events or things like that, or?
Sub-Saharan Africa, where the coverage of data is not that great, for example.
Okay. I want to go to a specific sector and ask about, we have investors, you probably hear 100 energy storage startup ideas a year, or 10. What is it going to take? I've been writing about clean tech for 10 years, and I've heard about energy storage being the holy grail. There's been some great legislation in the last year in California that's going to make energy storage happen. It's an exciting time, but you've seen 400 battery startups.
I don't know if it's 400 or 1,000.
100, 1,000, okay. Are they innovating at the material level? Is it a system level? Is it what innovations are you looking for, and what do you see? Is there a Moore's law in batteries or anything? Is there reason to think we can double and triple power density and the performance of a battery?
Well, I think clearly we can at least double the kilowatt hour per kilogram of a battery. I think you will see the price of kilowatt hour drop from up to $1,000 today down to, I can see it at $400 per kilowatt hour. So there is a lot of progress in battery technology. And there are, different types of batteries. It goes from lithium-ion to molten salt to all sorts of other ideas. But I think that storage in general, not just batteries, is a great area for innovation. But you want to build a 100 megawatt hour battery factory, it's about $60 million. Take a leave or a few dollars. So it's very difficult to do. This is what the point that you were making earlier, is that it requires a lot of capital to get it to be in the main tech area. And that, as you were saying, in addition to that, where are you going to do it? Because it's not easy to find the qualified workforce in this country. So a lot of the innovation is going to happen overseas. This is a totally different subject, but I happened to talk to somebody at MIT, the president of MIT, not too long ago, and I was telling him that we have a major problem because if we just develop things in this country and the production moves outside, eventually the development will suffer. Yeah. Because it's very important to have very close relationship between development and production. I come from both sides. I was in development and in production. And I can tell you, if that's divorced, eventually the people in China that are now producing product will start developing them. Remember the story of Japan. At first they were just making things. Now they've had their problems recently, but they are very innovative also. So I think it's a problem.
So there are deep structural, educational, and trade issues going on. It's not something that VCs can really impact too much unless when you form your foundation. Can you talk a little bit about energy storage from a later stage standpoint? Is it something you look at? Is it something you see a lot of deal flow on? Is it something you have an opinion on? Is it the holy grail of the grid, or is that just journalistic hype?
I mean, we're seeing a lot of proposals now because of the regulatory change for project financing opportunities with energy storage. Anything from compressed air to lithium ion on the grid to sodium sulfur. You know, at the end of the day, we are not fans of technologies that require, you know, government intervention to make it economical. So we're looking for projects that are economical and stand on their own and represent a better risk-adjusted return than everything else we could invest in. And we can invest in a lot of things right now that have a great risk-adjusted return. So when I see the energy storage deal that has a better risk-adjusted return than the 33 other things that I got in my inbox today, then that's the one
we'll keep your eyes on what's happening in the 50 megawatt Southern California Edison request for offer and the 1.3 gigawatt, because they are really trying to figure out a way to value energy storage and make it make it pencil out that way.
I'm more a believer in distributed storage. I think that small storage, 10 kilowatt, 20 kilowatt in houses or apartment buildings, definitely has a future as you see more and more photovoltaic being developed, being used in houses. A very good example of that is what's happening in Germany, where, I don't want to go into the details, but they have a terrible problem with their electrical production, the cost of electricity, which is, I think, 36 cents a kilowatt hour for consumers. They refuse to use nuclear or coal electrons. They're going to have, although they import electricity from France, Belgium, the Czech Republic, and Poland.
And they burn their share of brown coal.
I think that if you look, for instance, what's happening in Japan, there is a big market for 10 to 20 kilowatt storage in the houses. And I think that that could be more successful than a 50 megawatt
utility scale.
And you think?
We're invested in the companies doing just that in Japan.
Oh, you're such a good investor.
You might have read that Solar City announced an energy store.
Which company is it? Omron?
No, I mean, partly it takes a disaster for people to recognize the need for it, so it's post-Fukushima. And we're invested with some strategic partners, that home builders and others that can put these facilities into homes. And I think, when it gets economic, it will work its way to other countries.
Yeah. Okay. Eric, I think your comment on the value of storage is pretty key. There's, as far as I can see in the U.S., one sort of niche market, which is frequency regulation, where you can...
in PGM, right? Absolutely.
PGM, ERCOT, maybe, probably not California yet, but you see a few projects coming across that look somewhat feasible, and outside of that, there's really nothing happening. So I think one of the issues is that utilities don't really know how to categorize it. Is it generation?
Absolutely.
Is it part of their distribution or transmission infrastructure? So there's a lot of thinking and a lot of work to be done to establish markets for storage and help people figure out what the language is and what the
bromide is even if you could meet that $300 or $400 per kilowatt price, you could sell it at $0 and utilities still wouldn't know how to work with it because it wasn't regulatorily codified.
Mm-hmm.
Yeah.
Yep.
My understanding is that utilities are interested in having people store their PV, and so that it's easier for them after that to manage the grid.
Oh, I think there's a big fight going on right now where the CPUC is asking the three big California IOUs. The California IOUs are objecting to storage and holding back some of the storage projects because it's possible to game the net energy metering system. You're with me on this? You buy your energy, you download your brown energy when it's cheap, and you sell it back to the grid at a higher price because there's a net energy metering reward for it. And so that's what it's a specious argument, but that's the argument. I think it can be metered so that problem's obviated. Anyway, let's open it up to the audience. Okay, we have four great. I keep saying three great investors. You have to figure out the one that's not. We have four great investors and a real lot of experience, and so avail yourself to them and ask them some intelligent questions, please. And please phrase your questions in the form of a question.
This one is Scott Jacobs, and it's just give us some examples of the 7 to 8 investments that you've made that represent your thesis.
I knew you were going to ask that. We tend to keep these things under wraps, but
in a small room like this, you
small room
can certainly share.
with a video camera. So on the public side, we made an investment recently in a natural gas transportation-related company that has technology for the fuel system and for the tanks, the natural gas tanks for heavy fleets. So we have a thesis that natural gas for heavy fleets is sort of a big deal. It's not going to electrify, that's for sure. And natural gas is at least 50%, if not 70%.
Wait, so you said heavy fleets will not electrify?
Correct.
Okay.
Yeah.
Okay.
Not in the near term, certainly with energy storage prices where they are, speaking of energy storage. So we believe that a lot of the, there's a huge economic opportunity for heavy truck fleets to save money by converting from diesel to natural gas. And it's either a 50% savings all the way up to sort of 75 to 80% savings, depending on how many miles are traveled and what your routing is and whatnot. So we made an investment in a publicly traded company.
And that's the Pickens plan, right? That natural gas powering heavy fleets. Yeah?
Yep. I, in fact, brought the Pickens plan to President Obama on the transition team in 2008.
He's one of the three, then, clearly.
Still believe electrification of the passenger fleet is a great option, and natural gas for the heavy fleet. Another investment that we've made is in a sort of interesting early stage company that is bringing technologies from the West to make joint ventures in China and in the emerging markets. And we just backed this new platform. We're seed investors. It's a very early stage company. They're basically a services company where they'll be taking equity stakes in these joint ventures and providing advisory services to match up Chinese companies like the Bao Steels of the world to do deals like the Bao Steel and Lonzatex, which we're seeing increasingly. And so we believe that these guys are, this team is particularly well positioned to matchmake, essentially, to both evaluate technologies on behalf of the companies in the emerging markets that don't have the sourcing capabilities, the scouts, and for Western technology companies who are really skittish about making partnerships or just don't have the resources in-house to actually structure those partnerships to scale up their advanced technologies in emerging markets. So those are two examples on sort of opposite.
Thank you for asking that question, because Scott was rather flinchy about answering it when I asked him.
I guess I'll stand up. So, Pierre, or the team, you've spoken a little bit about the challenges for companies raising, Series B to maybe second valley of death, going to commercialization. I guess as one of the few companies that, that's what we're trying to do. So I guess for entrepreneurs in the audience, if you have words of wisdom, how do you, because there are companies eventually you do need to build a plant. Maybe it's not 60 million, maybe it's 20 or 30, and it's a big challenge, especially at what's happened in the venture capital world for this, I guess, for all of us here. What advice would you have for us on how we try and tackle this, like I said, second valley of death, if you would, or surviving through it?
Well, let me ask you a question. Is your first name Solar?
Yes.
That's difficult.
Middle East.
We're trying not
to. It's tough to find a bride when your name is Solar. I think you said...
They did change their name.
Yeah, I have a solar company. I suggested they change their name to whatever, Energy. But it didn't work. No, there are possibilities. Everybody thinks that Saudi Arabia and Mazda, etc., invest easily. Well, having dealt with them for quite a few years, since 2007 exactly, I can tell you that they are very, very slow to make a decision. It goes through many, many different levels, and I've been successful only in one case, so don't count too much on the Middle East. No, you got to find somebody that is a partner, a strategic partner that's interested in manufacturing the product. And don't give away your birthright. Try to work out a joint venture where at least you get some reward for the effort you have put in. But it is very difficult to find a partner in this country. I think it's practically impossible. First Solar and SunPower have been, are really two companies making solar material. I mean, Scion is in business, but it's very small. They've been making some acquisitions, as you know. Maybe that's what the direction you should go into. But I don't have any great ideas on how to help people in this. I mean, you know, I'm not on the board of Scion, but I'm involved in Scion indirectly. And it's very difficult. You know, they make a good product, good efficiency. They have a low cost. Their yield is good. But they compete against First Solar, who has a very strong balance sheet, and they can finance their own developments. The same is true, by the way, of SunPower. They have the French Total, the French petroleum company. So go to China. No, I'm serious. Go to China and find or Taiwan, and find somebody that's interested in your technology if it's really revolutionary.
What about Mississippi? I mean, Taiwan's had a good partnership there.
I'm an honorary citizen of Mississippi. Alibaba suggested one time that I moved there because taxes are less, but there are other reasons why I don't want to move there. But it's been a good place. You know, we have Cure is in Mississippi. Scion is in Mississippi. It's been a very good place to, you know, find people that want to work, want a job, want to work hard. The local authorities have been very good. I was talking earlier about the fact that we couldn't find, you know, vacuum technicians here. Over there, the local junior college suggested to us that they would train vacuum technicians for View. You know, this is the company making electrochromic glass. They have an incredible vacuum system, which is about 100 meters long. For those of you that are not in the metric system, it's over 300 feet. And, I mean it. I mean, it's an enormous vacuum system. They can do pieces of glass that are about 12 feet by 12 feet. And it's been a good place to work, but there the state basically gave them a loan to build a factory. Right. It's not equity.
Yeah. I'll just quickly say that I think the Valley of Death is another bit of misinformation that the media has propagated, which this space is rife with. The Valley of Death is a space where companies do go to die because they deserve to die. If you can't bridge it, it's because you don't have compelling technology. There are investors out there, and I don't know anything about your company. I'm just saying there's the first Valley of Death, the second Valley of Death, whatever. There is actually money for great companies. BrightSource even managed to bridge, you know, the Valley of Death with billions of dollars in need because they delivered a project that was very economical. Those investors are actually going to make a lot of money on that project, partly because of what the price of electricity was that was given to them at a subsidized rate. But nonetheless, you know, companies find capital. And what I've been surprised by, and no one's brought this up on this panel, private companies' pricing hasn't reset to reflect a dearth of capital in this space. We find far better priced opportunities from an investment standpoint in the public markets or in the non-venture financed private markets, because venture investors still think their companies are worth something way more than it's worth. And yet they decry that there's no capital available. Well, there is this thing called supply and demand, and it tends to usually find an equilibrium. And we have not seen that as much in the private market. So we've been really disinterested in venture-funded private companies because their pricing is still completely unrealistic. And so there's obviously some capital in the private market still holding those prices up. And it's coming from foundations and family offices and corporates and others who we think are pricing these things poorly.
Just add one more to your question. People have lost confidence in their ability to invest in the space because so much money has been lost. And so they're looking for third-party validation. Take Tesla, for example. Their third-party validation came from Daimler, Panasonic, and Toyota. If they didn't have those three partners and investors, they couldn't have gone public. Very meaningfully important to their success. So easier said than done, but if you can find strategic partners like that that would give confidence to Series B, Series C investors, it's very important.
Just like pharmaceuticals, right? Those technology developers found distributors for their technology, and that's how they bridge the valley of death for pharmaceuticals.
I'll come to visit you with some of my companies. They're not highly priced, believe me.
Here. You had made a whole bunch of disparaging remarks about storage companies, but it seems to me, investing in them, battery companies, et cetera. But it seems to me that if solar and wind type of technologies are going to survive, we need to have better storage technology in order for that to work. And if you're not, if the world doesn't invest, and maybe it isn't the right thing to talk to investors about this, but maybe from the point of view of the world, we had better invest in storage technology, or else these other things aren't going to work either.
I think I'll speak for the group. I don't think anyone was disparaging the asset class. Rather, just investing in companies is difficult because whether they're 400 or 1,000,
only two are going to survive.
Sorry, a few will survive, and the reason we're late-stage investors is because the one thing we know we don't have any comparative advantage in is identifying from a technological perspective which of the 400 is the best, or which of the three are the best. And we're probably not alone. So it's definitely something that's necessary, and several will arise from this difficult period.
So green tech lore has it that renewable energy can't be prevalent on the grid until there's energy storage, but that may or may not be the case. Germany's 53% of Germany's energy on September 10th came from renewable energy, and the grid did not blow up. All right, and that was not even a record of. And they have a different grid, and they use Scandinavian countries pumped hydro for storage. It's a different type of grid, but it's not a fait accompli that you have to have energy storage. Certainly not utility scale. Maybe behind the meter, like Pierre was talking about, these 10, 20 kilowatt batteries.
We have energy storage. It's called gas. We can smooth out any problem in the grid with peaker plants. That's what we do. We've been doing it for 20 years. So that's the challenge, is you have to compete with that as an energy storage manufacturer for the grid.
I'm going to quote Vinod. You know exactly what your competition is when it comes to energy storage. It's natural gas. So that's absolutely true. Sir.
Just a macroeconomic question. Maybe Stuart would be the right person, because I hear Goldman Sachs has an office on Wall Street, but the Fed, Mr. Bernanke and his successor, is engaging in quantitative easing, which is a euphemism for flooding the market with cash. $85 billion a month, $100 billion there, $100 billion there, adds up. Where's all this money going? All the interest rates are short-term are zero and longer-term are squat. Where's all this money going? I would think some of it would trickle down in some of these second-term available for investments in some of these. I would think people would, even though they weren't great investments, they would be able to get it. Is there a black hole someplace where the money they're generating is going, or is it just going back to being redeposited in the Fed or in the stock market? I mean, how can you free up $85 billion a month and not have any of it trickle down in these investment areas?
Yeah, well, I think the question is, given how low interest rates are, what are people doing with their money? It's one of the reasons you started to see positive fund flows into the equity markets, which even at 15 times forward earnings is still a relatively attractive asset class. Private equity is another place it's going. Hedge funds is another asset class is going. That's soaking up the majority of that money. The venture returns have been difficult, so I think, you talk to Pierre, better respond to this than I am. It's harder for many venture firms to raise capital. The top tier venture firms will continue to do it. They're 10 or 15. They have the best returns, and they'll attract the most capital, but it's still a very small amount of dollars relative to financial categories, more broadly speaking.
Yeah, we always focus on the 6, 8, 4, whatever billion of clean tech venture that there is, but in the new energy category, as Bloomberg New Energy Finance would characterize it, there's $200 billion a year in new energy capital flows, and that's primarily asset finance. It's $80 billion a year. It's like,
yeah, but that's including things like fracking and that type of technology. Isn't that considered new energy?
I don't think they define fracking. I don't think they put fracking in there. I think it's primarily renewables.
Speaking of infrastructure, so another one is infrastructure is a asset category that's very attractive. You can get a 6, 7, 8, 10% yield with low risk versus a much higher return with very high risk. People choose the former.
For your information, venture capital is a shrinking industry. There are now about 350 really active firms. There used to be 3 times as many. And the amount of money available is a lot less. And people are very, very careful, very cautious, because they want to be able to raise their next fund. So, why take a risk that will require $10 or $20 million investment, where with $20 million I can make $21 million investments in the next Twitter? And that's what we compete against when we go to try and raise money for one of our clean tech companies. And by the way, we do the same thing. If you look at Costa's portfolio, I think we've made 25 or 30 investments in small ones in Web 2.0 or whatever you want to call it, consumer web. And the money, we compete for the money, and that's always been the case, by the way. So I am not, to the point that I'm going to throw in the towel. I think just like your curve showed, this sine wave, eventually people will come back to look at clean tech. Interestingly enough, in the last 2 or 3 years, all of a sudden enterprise software is becoming again something that people invest in. Now, in my day, I did quite a few investments in that area, and I have one investment now, and it's not been difficult at all to raise the next round, the next 2 rounds. Because people look at that and they say, oh, we understand the market, we can see that you're not going to need $100 million to go public. It's easy. I mean, I found it like, this is the old days revisited. So, anyway.
I think from a project perspective, just one last comment is that a lot of people who invest in these large projects are comparing the returns they're getting on those projects to 10-year Treasury bonds, 20 and 30-year Treasury bonds. So if and when interest rates go up, the cost of renewable energy, which is totally driven by cost of capital, not totally, largely driven by cost of capital, will go up. So it'll be a headwind for the clean tech industry when that does happen, or at least the renewable energy industry when that does happen. Yeah.
Get worse. Yeah.
Sir? I liked Mr. Lamond's comment about inventing things in the U.S. and then manufacturing them outside. There is, however, one area where manufacturing is coming back to the U.S., and that is anything related to chemicals, especially because of the cheap natural gas and natural gas liquids. So I was wondering if you see that as a potential area of growth, or again, is the sheer size of the capital required prohibitive?
Well, certainly the fact that in this country, basically natural gas is for free, so it will certainly create some industry. And I've heard that the number of companies that had moved out of the States are coming back because just of the cost of the raw material. But this is not an area where I have any expertise, so I can't. Maybe you know more than I do.
There's a Kleiner-funded company called Siluria. I'm not sure if it's Kleiner funded. There's a company called Siluria that builds or fabricates ethylene from natural gas, a basic.
Well, there's more than one. I mean, there's
Sure.
quite a few.
So, I mean, I've heard that makes cheap natural gas is a American security advantage that is not talked about so much. When you have $2 gas to make your materials compared to $12 gas making your materials, it's an amazing advantage. There should be more innovation and investing in that area.
There was a comment about effectively how scary it is to make a $60 million investment in clean tech. I think that's not a big number if there's big money to be made. If you can tell yourself a story that you're going to be printing money, then that's not an issue. One example is Cheniere, which is a liquefied natural gas company. They spent billions making terminals to bring liquefied natural gas into the country. Gas prices crashed, fracking happened. Now they're spending billions to send it the other way. So you can tell yourself a story. There's a lot of capital out there.
That's fine.
My question is related to clean electrons versus dirtier electrons. I think a lot of the clean tech folks, even though that's not a term we use here anymore, would like to think that there should be a premium associated for a cleaner electron relative to a dirtier one. My question for the panel is, do you see any premiums for cleaner electrons versus ones that are dirtier, either now or going forward?
It's a great question.
I think in some consumer categories we're seeing, a premium on eco sensitivity or social responsibility, but when it comes to electrons, I don't think there's a whole big opportunity to focus on premiums being paid for greener electrons. That being said,
there are non-regulated utilities in the ERCOT region that sell green electricity for 2 cents more per kilowatt hour than non-green electricity.
People are definitely willing to do it, and that's what I was going to say. But you are seeing some retailers do it. But would I invest in that? It's hard to say until I see a presentation. But as a category or as a theme, I think we are ill-served by thinking that there is a premium available for green, and we are better served when we beat dirty on every important metric, and most importantly, cost. And we can, and we are, all over the place.
A lot of return on investments would happen much faster if there was a premium.
That's a government question.
Well, I mean,
it's good.
Well, but
Apple has invested a lot of money in North Carolina for solar and fuel cells to power a data center. Facebook and Microsoft are doing the same thing with PPAs, from what I understand.
But that's because it's cheaper. Microsoft is paying less and reducing its volatility for its power pricing by having a 20-year PPA directly purchased from a wind farm. It is a more economical, better answer for them, less volatility, and actually one of the big drivers for people buying power is to reduce their volatility. That's why people put commercial solar on their roofs as well. So it's not to say that cost is the only driver, but it is.
Well, the only reason that wind farm is economical is because of a production tax credit, which is the subsidy that Pierre talked about that distorts this industry.
I mean, renewables get far less subsidies than non-renewables, so do you want to get into that debate?
No.
I think it's a mistake to build a business model based on the theory that people pay more for clean electrons. It's a commodity. But my personal view is there hasn't been a penalty associated with dirty electrons. There are externalities associated with coal plants, health issues and pollution, and we're now just starting to figure out how to charge for that. We haven't gone far enough, but that will levelize the playing field, or level the playing field.
Let me butt in with one question. It's a big fundamental question. As distributed generation, as energy storage gets further out to the grid edge, utilities are under immense pressure. And again, it's an overused journalistic term, but the death spiral of the utilities seems to be occurring as more and more people are generating their own power and leaving less people to keep the grid upgraded. Utilities are in a bit of a panic mode. Are there investment opportunities in new utility models? Do you think that there is a glacial, is there a tectonic change in the way utilities are going to have to work? And are there investor, and I don't know about an early stage, but are there investor opportunities in investors make money in volatile times? It's a volatile time in the utility business. Are there opportunities? It's a $290 billion industry.
Well, you can go long distributed generation. You can go short utilities. The problem utilities are facing, the one you're referencing, is the very best customers utilities have, the ones paying the highest rates, are the ones most apt to want to buy distributed solar. And so then you've got the costs that you've got to then distribute to the rest of your customers. And believe it or not, something like 50% of PG&E's customer base gets subsidized rates. So you're distributing those additional costs to people that are already subsidized. So, I'm not sure, I don't know of a business opportunity that takes advantage of that specific issue, but it's clearly a problem for utilities, and they're focused on it.
We're wrapping it up? Okay. Well, you can swarm the panelists after we're done. Did you want to say a couple of words to finish?
Yes.
All right, so my name is Eric Westhoff. Pleasure being your moderator. I want to thank the great panel tonight. Thank you, guys.